So what can the health of one of the world's biggest banks tell us about our own financial health? Well, that's what we're here to find out. Today, we're giving JPMorgan Chase a full corporate health check. We're going to dive deep into their latest earnings report to see how they're doing, and more importantly, what it might signal for the rest of us and the economy as a whole.
All right, let's just jump right to the big flashy number. The main headline, $14.4 billion. That's the net income JPMorgan Chase pulled in for just one quarter. A single quarter. To put that into perspective, that's more than the annual GDP of dozens of countries. I mean, that is just a staggering amount of profit.
But a number that big, as impressive as it is really just the start of the story, isn't it? We got to ask, where did all that cash actually come from? How are the different parts of this financial giant really doing? And the big one, what does any of this mean for the rest of us? Well, that's exactly what we're going to dig into.
Okay, so here's our game plan. We're going to start with the big picture financial snapshot. Then we'll zoom in on the different parts of the bank, what they're doing for regular folks and what they're doing on Wall Street. We'll look at how they manage trillions in assets, and then to wrap it all up, we'll peek into their crystal ball and see what they think is coming next.
All right, let's dive right in. First up, the big picture, the financial snapshot for the whole firm.
And here's the other massive number that jumped out, $47.1 billion in total revenue. And get this, that's not just a huge figure on its own. It's a 9% jump from this time last year. That tells you they're seeing some really strong performance across the board.
So here's a quick look at the core results. You can see that huge revenue number, but right next to it, notice expenses also went up by about 8%. Now, the bank basically says this is the cost of doing business on this scale. Things like paying successful traders more and investing in new tech. It's that old saying, right? It costs money to make money, especially this much money.
Okay, so where did all that growth actually come from? Let's do our first deep dive and look at the consumer bank. This is the part of JPMorgan that most of us are familiar with, right? We're talking checking accounts, credit cards, car loans, that kind of thing. This is really the story of Main Street.
And the big headline from this part of the business? It's captured perfectly in this one quote from their earnings call. Consumers and small businesses are staying resilient. You hear all this talk about economic uncertainty, but according to JPMorgan's own data, the American consumer is actually holding up surprisingly well.
So why are they so confident? Well, a few big reasons. First, their data shows that people are, for the most part, paying their bills on time. Plus, customers are still parking their savings with them, so much so that they're #1 in retail deposits for the 5th year in a row. And hey, if you happen to have a Sapphire credit card, you were part of a record-breaking year for them. It all adds up to a really solid 9% revenue boost for their consumer division.
Okay, so let's shift gears now. We're moving from Main Street to Wall Street. We're talking about their corporate and investment bank. This is the absolute powerhouse division that deals with giant corporations, governments, you name it.
And wow, this division was on fire this quarter. Revenue here surged an incredible 17% compared to last year. This was a massive, massive engine driving the whole company's amazing results.
So what was behind that huge 17% jump? Well, a big piece of the puzzle was their equities business, helping companies go public and trading stocks. That part was up a staggering 33%, mostly because the market for IPOs was really hot. But it wasn't just that. Trading in things like bonds and currencies was also really strong, and so were their investment banking fees. Just really solid performance all around on the Wall Street side.
All right, our last big stop on this tour is asset and wealth management. This is the part of the bank that's all about managing money, investments for millions of people and big institutions all over the globe. Now, before we get into the numbers here, there's a key term you got to know, assets under management, or just AUM. It's pretty much exactly what it sounds like. It's the grand total market value of all the investments they're handling for their clients. Think of it as the main scorecard for this part of the business.
And their scorecard is looking pretty good. In just 3 months, clients poured an extra $72 billion of new money into their funds. That's what's called net inflows. And a number like that, well, it signals a massive amount of confidence from their clients.
And all that new money coming in helped push their total assets under management to a number that's just hard to wrap your head around. $4.6 trillion. That's with a T. It's an 18% jump from last year, and it's a mix of that new client money we just talked about, plus their existing investments just doing well.
So it's pretty clear the bank had a fantastic quarter, pretty much across the board. But what about the future? What's coming down the road?
In our last section here, we're going to look at the guidance the company gave for what they see ahead.
So what does their crystal ball say for the rest of the year? Well, they're basically expecting the good times to keep rolling right on through the fourth quarter. Now, they are also planning for expenses to go up a bit, which makes sense when revenue is this strong. But here's a key detail. They expect the rate of people not being able to pay their credit card bills to stay low. And that's another really strong signal that they believe consumers are still doing okay.
Now, when they started talking about 2026, they were really careful to put a big disclaimer on it. They gave a preliminary forecast, sure, but they made it super clear that it's subject to the usual caveats. In other words, hey, this is our best guess right now, but a lot could change. Okay, so keeping that disclaimer in mind, what is their early projection for 2026? They're forecasting around $95 billion in something called net interest income. That's a super important number for banks. It's basically the profit they make just from lending money. So even though it's early, that's a pretty powerful signal that they're confident things will continue to go well.
And there you have it, our health check is complete. And really, the big takeaway seems to be a tale of two realities. On one hand, you have this financial giant just firing on all cylinders right now, with data showing that consumers and businesses are surprisingly resilient. But woven into all that good news is this clear sense of caution, right? This awareness that things are uncertain, and this focus on getting ready for, well, whatever comes next. And that kind of leaves us with the big question. What exactly are they preparing for?